So tonight we're going to talk about starting a farm in Ontario, and we're going to focus on crops. So the first thing is that, as I said, lots of information is going to be thrown at you. Tonight's webinar is going to be spread out over two major topics. One is, how do you get started in terms of, your more of your general business information. And then we're going to start focusing on near the end, we're going to focus on crops, or halfway through, we're going to focus on crop farming, the different aspects that you'll have to keep in mind. So we'll get started. As mentioned earlier, if you have any questions, pop them in the chat box. We're also probably going to try and take a 5-minute break halfway through, or a couple-minute break, because I'll probably have to take a breather or two and maybe rehydrate and stretch my legs. So, but we'll get started anyway. So one thing I will mention before we get started that, so tonight's presentation, as well as the next two presentations, is more focusing on providing background information for you. Please, before you make any hard-hitting decisions, reach out to your advisors, your accountants, lawyers, depending on your scenario, lenders, any sort of consultants or mentors. They will be able to walk with you in any sort of decision making and provide those crucial resources that you do need. And as a reminder that especially when it comes to the world of finance or taxation, things change on a very quick basis. So everything's up to date as of today. But if you're re-listening to this presentation in a few months, things might have changed. So just keep that in mind. So I guess the first thing before we start getting into the different aspects of starting a farm in Ontario, you should take the time and ask yourself, what's the idea, or what's your thoughts as to why you want to start a farm, or why do you want to become a farmer? And as you say, as mentioned earlier in the roundtable at the beginning here, that farming is can be a tough industry to get started in and to survive, and but it is also very rewarding at the same time. So you just have to make sure that when you're about to go dip both feet into the pool, make sure that that this is something that you want to do. So as you say, what are the pros and cons of starting a farm? Do you have the skills, both the personal and the business skills and the agronomic skills to start a farm? Or if you don't, how are you going to get those skills? And I think for you all who is attending this webinar, you're making the first step to making sure that you are up to date and enhancing your skills. So just keep in mind that starting a farm is a tough job, but at the same time though, it can be quite rewarding. So now we're going to get started into the general business. And the first thing we're going to talk about is business plans. So, so what is a business plan? So the idea of a business plan is to provide, or it's a management tool that allows you to go through what's the purpose of your business? How is the business going to survive? How is the business going to, start and grow and thrive? So as mentioned here, it's a game plan. Most people, when they think of a business plan, they will say, oh yeah, I've thought about a business plan, it's all in my head. I know what I'm going to do when we get started, or when we first buy that 100-acre farm, or rent, we got the land rented. But it's always a good idea to actually take the time when it comes to a business plan and write it out, because sometimes there's that disconnect between what you think of and what you actually write down on with pen and paper. There's a disconnect, so you just have to keep in mind. And one thing I will mention too, just briefly, when it comes to a business plan, it is a living document. It's not one of those things that is cast in stone, because as you say, when it comes to farming or starting any sort of business, things change. And so with that, your business plan may have to change to adapt with the current situation. So And as I mentioned most of this already, so you can take the time with your handouts and kind of read this through a little bit more on your time. Again, one thing I will identify something of use is decision making and communication when it comes to your business plan, because when it comes to starting a farm, if you're doing it by yourself, good for you. But in 99.9% of the time, that there's always either spouses that are involved, wives, husbands. There's also, family members, if it's parents or children. So by working with them and having a business plan and communicate that business plan with your family, that way then they can know kind of how they can help you and how they can provide support for you when times do get on the tough side. So when it comes to what makes up a business plan, there's a few sections that are in a business plan. Now, one thing I will say is that each farm or each business is different. So in some cases, if you compare a business plan from one farmer or one business to another business, they might look slightly different, but they'll cover off the following aspects. So the first aspect is, what is the business profile, or a quick summary as to what is the purpose of your farm, a marketing plan, production plan, human resources plan, financial plan, and depending on where you are in life, a succession plan, and that can change depending on if you're just about to get started, or if you are more looking at the next generation. And then finally, any other documents that might be useful to help communicate the different ideas within your business plan. So when it comes to the executive summary and the business profile, again, the idea of it is it's just to provide a general background information as to what your farm business is actually going to be. So again, what's the purpose? What is the concept of your business? What's your target? What do you ultimately want to accomplish when you start your farm business, or once you start expanding, if that's within your realm, right? So and a target can be as simple as, I just want to survive. That might be a pretty low target, but it can be providing consumers with a specific type of product, right? If it's an organic product, or if it's sustainable raised or grown type product, that's where you get into that. Also too, talks about kind of what your business, how it's structured. So are you a sole proprietorship? Are you a partnership? Are you a corporation? And as you say, for starting a farm, most people won't be at a corporation stage, but depending on how things grow, a corporation might be within your horizon. And then also any other useful information that might benefit your business plan. So like, who's all within your management team? Do you have any sort of mentors that you can call up at any time and ask any sort of questions, right? So so those are just the brief summary of the executive summary and the business profile. And as I said earlier, when it comes for each section, each person, each business is going to be slightly different. So you do not necessarily need to take this as, you must hit X and Y and Z. It might be, one person might only have to focus on one or two items, and other people might focus on a couple of different items. So just keep that in mind.
Erich, are there sample business plans available for a farm?
Yeah, so if you go, so I know with OMAFRA, and we'll talk about OMAFRA resources near the end of the presentation, OMAFRA does have fact sheets that go into more detailed explanations about writing business plans. If you just go onto a simple Google search and look at business plan samples, there are a couple, especially more so in the US, but there are a couple of business plan samples that you can look at that do focus on farming. And but we can get more into that a little bit later. But again, if you just do a quick Google search, you'll be able to spot a few, and I can find a few samples and I can send it to you that I can then send it to the registrants of tonight's session.
Thanks, Eric.
And yeah, thank you for the question, because that's a very good question. So next on the list is marketing plan. So in general, the whole idea of a marketing plan is to identify, what industry you're involved with. So as you say, when we talk about crops, I think most people will think about, the traditional cropping farming. So that's your, corn, soybeans, wheat, your broadacre. But when it comes to crops, there are other crops like, as you say, apples, your fruits, your vegetables, and whatnot. So with a marketing plan, you have to identify, what are you going to be growing, and how are you going to ultimately sell these crops? So again, the question is that for a farmer that deals with corn, soybeans, wheat, they will be focusing more on, well, they're going to sell the crops to a local elevator. Whereas, somebody who is has, maybe 5, 10, 15 acres of, CSA type vegetable garden, they may be looking at, as you say, creating a CSA and, selling directly to the consumer. So the idea of this plan is to identify, how you're going to sell it, to whom are you going to sell it, and ultimately, what is the price? How do you determine your selling price, right? Because as you say, when it comes to your broad acres, so your corn, soybean, wheat, they're going to be focusing on, when it comes to selling price, you're dictated by the market, you're dictated by the elevator. Whereas if you are dealing in the fruit and vegetable and selling directly to the consumer, you ultimately do have more control, but at the same time, though, your customer has to actually want to pay that price for that product, right? So you have to determine what those different prices are. And then finally, how are you going to promote your product? Again, going back to, selling directly to the consumer, are you just going to go through, having your own website, or are you just going to have flyers around your local area, or are you going to go to different farmers market? So by taking the time and understanding, how are you ultimately going to sell your product is a very important aspect when it comes to the marketing plan. And then one comment I will make too is that when it comes to marketing, there's the 4 Ps. So that's your product, price, promotion, and place, which is ultimately your distribution. So ultimately, when it comes to your marketing plan, you should be able to address those 4 key elements when it comes to your marketing plan. So when it comes to going into a little bit more detail, just very quickly here, and again, when it's a tale of 2 stories when you're dealing with crops, because as you say, when you're dealing with corn, soybean, wheat type crops, as you say, the market is already established, and as you say, that's a little bit outside of your control. But if you're dealing with more of your fruits and vegetables and selling directly to consumer, again, you can look at this at your marketing plan, look at what are the different conditions, what's the economy, how are people willing to pay maybe a little bit extra to know where their fruit and vegetables or any other product that you might be growing or raising, are they willing to pay a little bit extra because they know how it's been produced, or where it's been produced. So just keep that in mind. So we'll switch over to the production plan. So this is actually where you get into the nitty-gritty of, so I have a place to sell my products. Now, how am I going to produce said products or crops in this case? So the big thing I think that you'll want to answer in this point in your business plan is, are you going to be focusing on sustainable farming, or are you going to be focusing on organic farming, or are you going to be focusing on more conventional farming methods? This is where you start and have that conversation, or you spell out within your business plan that, you know, you're going to be focusing on, you know, X or Y or Z. In addition, you're going to be focusing on, you know, what type of resources that you have at your disposal. So like, as you say, land, do you own your land, or do you rent your land? Because that can play an interesting role if you are planning on growing any sort of, you know, crops that take multiple years to grow. So like apples, grapes, etc. You're probably not going to do that on rented land. Or if you do, you'll have to make sure that you have to sign a written agreement that's for more than 1 year at a time. And with this production plan portion of your business plan, you outline, you know, how you're going to ultimately grow those crops. So switching gears for a second to the human resources. So this is, if you don't have any employees, it will look slightly different than if you do have any employees. But ultimately, as I said earlier, this is going to be a team effort between you and your family. If it's, you know, your spouse, or if it's your children, or if it's your parents or brothers or sisters, outline, you know, who's going to be involved with the day-to-day business. If it's, you know, if it's just yourself that's going to be going out into the fields and, you know, working the fields, growing the crops and harvesting the crops, that's one thing. But then again, is there anybody going to be working on the business side of the things? You know, if it's going to be focusing on, you know, getting the income tax prepared, or any specific documents. So this is where you would outline, you know, as to, you know, who's doing what, kind of what their skill level is. As you say, you know, if you have a family member who is an accountant, then as you say, most likely that family member is going to be focusing on the bookkeeping and the income tax preparation. So just keep that in mind. And then ultimately, like with any human resources, how are you going to compensate your employees or your workers? As you say, family is one thing, because, you know, there's always that ability to twist somebody's arm to maybe help out in a pinch. But ultimately, at the end of the day, when it comes to human resources, you have to provide some form of compensation to those helpers and workers. Moving on to the financial plan. So as a person, I cannot believe I forgot to introduce myself. I am an accountant by trade, as well as a farmer. So a financial plan to me is a very important aspect with my financial accounting hat on. The whole idea of the financial plan is to actually, you know, provide the dollars and cents to your business plan. So as we talked about earlier, we talked about how we're going to sell the product, how we're going to grow the product, and how we're going to, you know, have the employees or the workers or the helpers to keep the business going. Now we're going to have to look at, you know, how are we going to make money? And if you're in a situation where you have to go and receive credit, which I'm almost willing to bet everybody will have to focus on that too, including myself, your lender is going to be wanting to see your financial plan, especially, and making sure that your financial plan makes sense. So one thing I will say, that when it comes to the typical components of a financial plan, you'll see an income statement. So that is outlining your income and expenses of your business. Your cash flow statement, so that is the monitoring your cash going in and going out of your business. So money coming in from selling the products or crops, money going out to pay for like inputs, wages, etc. Any sort of a balance sheet. So depending on how you are starting, if you have that 100-acre property, or you have a property already, or if you're looking to get that property, what are your assets that you have, and then what's the debt? Do you have any debt at this point in time? That's where you'll show that on your balance sheet. And then also, you know, capital sales and purchases. So what I'm referring to is, you know, Are you planning on selling any sort of equipment if you have equipment, or do you need to buy equipment? It's pretty hard to work a 100-acre farm if you don't have a tractor. You can do a lot of custom, get a lot of people to do the work for you, but ultimately most people do need a tractor to do the odd jobs around the farm. So that's where you would outline that. And then in short, how you're going to finance it, what is the interest rates that you're dealing with, and so on and so forth. One thing I do want to make a quick point too at the very bottom of the slide, profit is one of those elusive things in farming sometimes, especially when it comes to starting a farm. So when you're working with a lender or any sort of investor, if that's what you're going to do, profit is, you may not be able to show a profit within the first year or within the first couple of months, but you'll have to be able to ultimately prove to that lender or investor that this is a profitable business, and be able to, as you say, show that there's a light at the end of the tunnel when it comes to, the success of your business. So, and just in brief here, because I know we are short in time. So what a good business plan is, in my eyes, is one that gets used on a very regular basis. And I know from my perspective, I hear a lot of stories about people that will take the time, they'll write out the business plan and, put a lot of effort into it. And then they will put that business plan on a shelf and not look at it for 5 years, and then realize, we have this business plan, brush the dust off, and then try and figure out where they went wrong. So the first thing I want to say is that a business plan should be pulled out at least annually, if not sooner, so that you can show that you can determine, okay, this is what happened in the past year. This is what the business plan was telling us what we should be doing. What has happened? Was there an external force, like whether we got into a drought situation or we got too much rain, or crops, we planted it, we did everything we could, but something happened, a pest or a disease came in, so we were not able to meet our goals. So it's fine to be different or at odds with your business plan, but you have to be able to determine why and figure out what you can do different for next year so that you don't have those issues. So finally, when it comes to a business plan, it does take time. This is not something you'll be able to get completed within a night. So just keep that in mind. It's one of those things where you have to make sure that you take the time, analyze your situation, and then put that into your business plan. Yes, there are samples out in the internet that you can use as a starting point, but you should not necessarily be copy and pasting for your business plan, because that's not going to be good enough, because each business is going to be so vastly different. And that's where my final comment about business plans will end. So I know that's a lot to go over. We're going to keep rolling on because time is getting short. So we'll start off with business structures. So very briefly, and again, it sounds like that most people here tonight have already a farm in progress. So either they have bought a farm, or a farm has been given to them, or they've rented. So I'm almost willing to bet money that tonight people that will be watching this seminar will be considered sole proprietor. But tonight we're going to just go through the 3 different business structures for your farm operation. There's more different structures out there, but these are the more common ones that you will most likely be using. The other structures are a lot more complicated, maybe for a bigger operation. So we'll just focus on these 3 for tonight, and then we'll get started. So again, the 3 we're going to look at are sole proprietor, partnership, and a corporation. So sole proprietor business structure is the simplest, the easiest structure that you can develop, because you as a person is the business. So for myself, for instance, with my farm, my farm is Erich Weber, and that's it. You know, there's no agreements, no shareholder agreements, no partnership, no corporation. It's just me and me alone. So as you say, it refers to the person that owns the business. There is some advantages and disadvantages when it comes to sole proprietorship. So advantages are simple to set up. You as a person receive all the monies all the profits that you get for the business go directly to you, and you ultimately control all the business decisions. So that's a pretty sweet deal. But then there's also some disadvantages. So main thing is that it can lead to higher taxes because ultimately that business income, the business profits will be taxed at a personal tax rate, and that changes depending on what outside income that you are receiving. So it could lead to some more higher taxes being paid compared to other business structures. It is not a legal entity, so what that means is that it's not a standalone. So if something happens to your farm operation, because you are the business owner and the business is you, ultimately you could get into certain issues with lawsuits where if it's a corporation, the lawsuit, God forbid that ever happens, would be focused on the corporation, and you as the shareholder would be more protected. But as a sole proprietor, whatever happens, it happens to you directly. So that's not an advantage for you, but it's one of those situations. And then ultimately, in my last point there, you are personally liable for all the business decisions. So like when it comes to your farm, you're making decisions on a daily, hourly, minute by minute basis, depending on the situation or how busy the day is. Ultimately, at the end of the day, the buck stops with you. So where in other business structures, you have that flexibility. Couple of quick financial considerations. You are personally responsible for any and all business debt. So when you go into see a lender, they may talk about, you know, this is your business mortgage or business loans or leases or whatnot. But at the end of the day, if the business is not able to keep up with those payments, they're going to be the lender will be knocking on your door saying, okay, it is time your business is not able to make these payments, so you have to make the payments personally. So that's outside income or selling personal assets that are not within your business operation. So you have to keep that in mind. And there's a couple of situations where you may not be eligible for some government funding programs, but that's more of a situation on a case-by-case basis. And when it comes to the income tax, all the income and business losses for your farm would be documented on your personal income tax. Legal consideration, quite quickly, there's no separate agreements that you would have to complete as a sole proprietor compared to a partnership or a corporation. And ultimately, you are responsible for any and all actions that your business is involved with. So switching gears to a partnership. So it involves two or more persons that carry on a shared business. So in most cases, you'll deal with partnerships that are, you know, 2 or 3 people within families or maybe some outside investors. You can get a partnership when you're dealing with corporations, but that's going at a very deep level there. So we're not going to get into that per se, but we're just going to focus on partnerships that are dealing with people. It can be a complex legal agreement or implied partnership. So what I'm referring to when it comes to an implied partnership, that's a partnership between spouses, so husband and wife team or whatnot, through marriage or common law marriage. Those will be considered to be more the implied partnership. Complex legal agreements, so that will be, you know, having a partnership agreement, so that we'll get into a little bit more detail a little bit later on. So when it comes to advantages and disadvantages with partnerships, so it is a lower cost to set up compared to other business structures like corporations. Not as low as a sole proprietor, but definitely cheaper compared to setting up a corporation. In some cases, you do not necessarily need to have a formal agreement required. So I'm referring to more so for those implied partnerships. But ultimately, having a written agreement is key to prevent issues down the road, and we'll get into that a little bit later on. And easier dissolution compared to a corporation. So those are your advantages. Your disadvantages, again, the liability, it would be shared among all the partners of the business, but at the same time, though, it ultimately falls on you as a person who's a partner of that farm business. That's can lead to some issues down the road. You do not have any protection from the progressive individual tax rates for your income tax. So again, when it comes to any sort of income being received by a partnership, it goes directly to your share. Your share goes directly to your personal income tax. So not like a corporation where there's a specific income tax rate just for corporations. And finally, you'll have to be very detail oriented when it comes to the record keeping for a partnership, just because of the fact that you are dealing with multiple partners and sometimes partners that are outside your family circuit. So you'll have to make sure that everything is fully detailed and recorded to prevent any issues down the road. So some legal considerations very briefly. Again, you can share the liability with your partners, but at the same time, though, similar to a sole proprietorship, that ultimately the buck stops with you. As I mentioned here, that you do not necessarily have to have a formal legal agreement in some scenarios, but at the same time, though, it's strongly encouraged to take the time and outline, what's the role of each partner in case of death or in case of marriage breakdown, or as you say, what happens when a partner wants to sell their shares? Can they sell their shares to just anybody, or do other partners get first crack at the can? That's where a partnership agreement is good to have written down. And you can see here on the bottom of your slides about what happens if there's any sort of disagreements, what happens if there's any, a divorce or death that may happen. Financial considerations, again, when a sole proprietorship, you ultimately make the decision, but as a partnership, you ultimately have to share the decision making among 3 or 4 or 2 different people. And it depends on how big your partnership's going to be. Also, who owns the asset, who gets what percentage? Is it simple split between all the partners for profits, or does one partner get a little bit more because they do a little bit more work or less work or a different type of work? So you have to take the time and figure out the different aspects when it comes to your partnership. So corporations, I'm going to go through this relatively quickly. So it's a standalone legal entity. So ultimately, in short, when it comes to a corporation, it can go and borrow debt. It can pretty much do anything that a human being can do, except for it cannot vote, among other things. But ultimately, it can incur debt like a person. It can be sued by a person similar to a person. Again, the corporations you have a lot more record keeping, a lot more paperwork that has to be completed. So you're more so going to see this in more larger farms, farming operations, but in some circumstances, it might be beneficial to you. So again, when it comes to corporations, you want to make sure you're working with your accountant and lawyer to make sure that's the right fit. So just very briefly, I mentioned most of this already when it comes to the advantages and disadvantages. Very quickly, that as a shareholder of a corporation, you do not have the same liability compared to a sole proprietorship or a partnership, because ultimately the corporation would be the business that gets sued, not necessarily the shareholders. And if that's the case with shareholders, there are ways to mitigate that risk. One thing I will mention when it comes to disadvantages, there's a lot higher costs involved to setting up a corporation compared to a sole proprietorship and a partnership, as well as it can be very complicated to dissolve a corporation, to end the corporation. So just keep that in mind. So when it comes to legal considerations, again, you will have, terms of incorporation, and a former shareholder agreement is usually required depending on the different shareholders. And as you say, how are shares going to be distributed? What are the rules, and what are the roles of the shareholders? And ultimately, when it comes to financial considerations, what are the different financial benefits that you may lose if you may lose or gain, I should say, when it comes to incorporating? Because as a corporate farm or corporate business, you do have different rules that you have to follow compared to a sole proprietor. So that's a very brief, very quick review over business structures. We're going to jump right into financing options for just, to buy a farm business or buying farmland. I'm going to do this as a high level because each situation for the people on the line here are slightly different. So just, keep that in mind that, we're going to look at this as a very high level overview. So long story short, I'm quite sure everybody knows what land prices are doing. They seem to keep going up, and it's pretty hard for a person or group of people to all to go out and buy farmland using cash. So you're going to be having to get some debt. And it's not just land, it's also equipment, inventory, any sort of buildings. If you have to do any buildings, again, everything is to a point where you usually do need to use debt. So when it comes to land or any sort of major building renovations or building building any new buildings, you'll most likely be using a traditional mortgage. It's the most common option for farmers. And again, here you're going to be working with a chartered bank, so your RBCs, CIBCs, TD, Scotia, BMO. I know there's some other ones out there that I'm probably forgetting off the top of my head. So just chartered banks in general, or credit unions, crown corporations. You can also use family members as well as private third parties. So that could be neighbors, that could be your private mortgage lenders. So that's the more traditional way. We'll just focus we'll break this down between like your banks, credit unions, and crown corporations. So, and then we'll get into family mortgages as well as third-party mortgages. But when it comes to, dealing with banks, credit unions, and crown corporations, again, they're going to offer, in most cases, a 25 to 30-year mortgage amortization, the life of the mortgage. Interest rates can be variable or fixed. I'm quite sure that everybody has noticed within the last year what prime rates, the interest rates have been doing. It's an interesting time for sure to incur any sort of debt with the way interest rates have been reacting. In some cases, fixed rates can be fixed for 5 years of the mortgage. In some cases, it could be 7 or 10, depending on which lender you're working with. Variable rates, again, that changes with the prime. So before 2022, it was pretty simplistic for a variable rate mortgage because prime did not change that often. Now, within the last 12 to 16 months, prime has changed quite a bit. So variable rate mortgages have seen a little bit more activity than they have in the past. When it comes to mortgages, land is usually the most common collateral, and most lenders will lend up to 70 to 80% of the asset value or the land value, depending on the situation. Switching over to families. So here, working with family members for mortgages or any sort of loans. It can be as the sky is the limit, you could say, in terms of how these mortgages can be created. It can be longer than 30 years, the mortgage. Interest rates may be in line with what the lenders are offering. It may not be. It might be at a very preferential rate of interest. That's the joys of working with family members. With that being said, there's other issues to keep that in mind. When it comes to working with family members or having any sort of debts, you want to make sure that everything's written out explicitly clear as to what the person, the family member who's loaning you the money, and you as a business owner, how you're going to repay the money. Because ultimately, there's going to be some form of repayment one way or another. And then finally, third-party mortgages. So as I mentioned, these are your neighbors, farmland owners who are looking to sell. So there are different scenarios where there are farmers that are looking to sell. Maybe none of their children are interested in taking over the farm. So maybe they are willing to allow you to work the farm, buy the farm, but will give you a mortgage as a take back. So that gives you a little bit of a helping start. Again, when it comes to this, it's not necessarily the same as a family mortgage where the sky's the limit. They will most likely be looking at what the lenders are charging or the lender rules. It truly depends on the person that's on the other end loaning you that money. So it really depends. One thing you may have heard of are young farmer loans. So there are some lenders out there that provide young farmer loans. So this is for people to get started in the agriculture sector. Each institution, each lender who offers these types of loans will have different rules, but just in general, you'll see that the amortization or the life of the mortgage will be at 25 years. Interest rates are usually at a cheaper rate compared to a traditional mortgage. Also, too, some lenders may offer you additional support. So if it's mentoring or coaching or any sort of discounts for financial software, that's each lender will be slightly different. And then in terms of who can qualify for these types of loans, again, there's some lenders that may say 40 is the cutoff. There might be some lenders that might say 35 is the cutoff. So just keep that in mind that when you're talking with your lenders about young farmer loans, if they do have any, make sure you understand the rules of the program, because in some cases, the moment that you hit that magical age, whatever it is, then there might be higher interest rates you may have to charge that you may be incurring, or additional fees or whatnot. So just keep that in mind. So as mentioned, just make sure you know the rules when it comes to these young farmer loans, because each loan is slightly different. Very quickly, the Canadian Agriculture Loans Act. This is a program that is created by the Agriculture and Agri-Food Canada federal government. So 95% of the loans value is backed by the federal government. Very briefly, when it comes to this type of program, it's not that well known. Ultimately, you'll have to go to a charter bank or a credit union to ask for this type of loan program. But just very briefly, the maximum loan amount you can receive is $500,000. And that's if you're buying land, which I know buying land for $500,000 nowadays is pretty tough, unless it's very small portion of land, like a very small parcel. But again, ultimately, you have to work with a chartered bank or credit union to participate in this type of a program. In terms of interest on these types of loans, they can be variable or fixed depending on which option you choose. Variable rate is based on prime, whereas fixed is based on the lending institution's residential rate. So If you were buying a house, you'll be looking at interest rates if you were buying a house. One thing when it comes to the Collar Loan Program, it is for 15 years. Ultimately, to get this type of loan to be spread out over 25 years, you would have to take it out for the full 15 years. And then in 10 years, and at the end of that term, then you go and refinance that final portion for the additional 10 years. But again, you'll have to work with your charter bank to work with this type of a loan program. Farm business registration. And again, I apologize. I know I'm going really quick, but again, lots of information. So please ask away any sort of questions within the chat, and go through your handouts at your own leisure as well. So farm business registration, or FBR number, that's a requirement for all farmers who that have gross farm revenue greater than $7,000. When it comes to this program, you will have to pay a $255 plus HST membership fee to an accredited farm organization. The deadline to renew, if you're already a farmer, is March 1st. But if you're a new farmer, you can apply for this program throughout the year. And we'll go into what to do when you're a new farmer in a second. By having a farm business registration number, it allows you to participate in the farm property tax class program. We'll talk about in a second. Allows you to become a member of an accredited farm organization. And there are certain cost share programs available that will require you to have a valid farm business registration number or a valid farm business registration exception. So as a new farmer, you can apply in the program anytime throughout the year. You do have to reach out to AgriCorps. That is the Crown Corporation that deals with the Farm Business Registration Program. You will have to provide or maybe asked to provide a copy of your income tax return to show or to prove that you have obtained gross farm revenue or gross farm sales of greater than $7,000. One thing I will mention, when I refer to gross farm sales of $7,000, that is just the sales. That's not profit. That's just quite literally, if you sold any sort of crop and you've received $7,000, that's all it takes to become a farm, to obtain a farm business registration number. It's not the profit. You're not factoring in any sort of expenses. It's just quite literally, if you received a check from somebody for the sale of crops that it equates to $7,000 or more, then you are required to register within this program. The farm property tax class program, if you own farmland, this allows you to be taxed at 25% of the residential tax rate. This preferential rate does not apply to a house and associated land on your farm. So usually when I refer to any sort of associated land with that house, they usually factor in about an acre or two, depending on the scenario. But then if you own 100 acres, 98 will be taxed at 25% of the residential tax rate, where the final 2 acres plus the house will be taxed as a residential property. If you are renting any sort of farmland, your landlord might require you to provide your farm business registration number, because as a landlord, even though you may not be, the landlord's not actually doing the farming, but their land is ultimately being farmed, they can reach out to AgriCorps and submit your farm business registration number so that they can take advantage of this type of a program. So just keep that in mind. And again, when it comes to the farm property tax class program, that's all done through AgriCorps, and you'll see the link on your screen there for more information. Accredited farm organizations, so they are there to support you as a farmer, to be your voice for any sort of government issues or any other stakeholders. So if there's something big happening within your industry, that's where your accredited farm organizations will step in and, work with farmers or work with government to come to a solution. Depending on the accredited farm organizations that you're dealing with, they may offer additional benefits to their members. So if it's program discounts or, maybe offers some form of health insurance or whatnot, that is something to keep in mind. The only three accredited farm organizations in Ontario, and in no particular order, are the Ontario Federation of Agriculture, the Christian Farmers Federation of Agriculture of Ontario, I should say, and the National Farmers Union of Ontario. Quite literally, you can go to Google and just enter these names into the internet, and they'll take you to their website. And again, you as a registrant of this type of program, so your membership fee or your fee that you pay when you register your farm business registration number, that goes towards one of the three accredited farm organizations. And but it's within your right that if you don't want to become a member of these organizations, you can refund your farm business registration fee. You do have till May 31st, but most people will keep their membership fee within one of these three organizations, because ultimately there's some benefit to, because they provide some key information, they support you in other ways. There's depending on the situation, depending on the organization, they will have reps within different counties or within the county that can help you with any sort of questions. So just keep that in mind. So we're now going to switch over into general record keeping, and then after this, we'll take a quick break just to give people some time to stretch their legs. So why is record keeping important? So by keeping accurate records, allows you as a farm business owner or manager to make informed, timely decisions. Having good records will reduce or at least mitigate any sort of environmental or legal risks that might happen. Environmental be more so like if you are spraying any sort of crops or if you're applying any sort of nutrients. By having detailed records, they can help you if there's any sort of issues that happen on your farm. Farm Management Canada, which we'll talk about in terms of list of resources at the end of the presentation, they have conducted two reports. They're both called Dollars and Cents. So the first one was done in 2015 and the last one was just done in, I think, 2021. And both reports came to the conclusion that the most profitable producers found that keeping detailed records that are used on a very regular basis was a key contributor to their success. So keeping those records in good order is very important. So when it comes to the different types of records you might be dealing with, again, your records are going to be dealing with, most likely, your government commodity organizations. We can go into that a little bit more detailed, or for your own type of analysis. So again, we'll talk about later on in the presentation about, cost production, any sort of field plans or field profitability or crop profitability. That's more of your internal analysis. So when it comes to a government and commodity organization where they are requiring you to have records, they'll have that spelled out in pretty black and white detail, so that they are telling you that you must keep X, you must keep Y. But when it comes to records that you use for your own internal decision making, that can be as flexible as what you need it to be, because ultimately the records that you need for your internal analysis is based on what your operation requires. So we're going to look at just a couple general record keeping items that apply to all farmers. A little bit later on we'll get into more specifics, but very quickly, income tax or HST. Again, ultimately, when it comes to reporting your income and expenses for your income tax or when you're applying for HST. You do need to be able to have backup records or invoices or receipts that show when you made any purchases, what's the seller or who was the buyer of the crop, the name of who received that money or had paid out that money, what was purchased or sold, and then as you say, if there was HST involved, how much HST was paid and what was the HST number of the seller, or if you have an HST number and you are performing any services, and we'll get into HST a little bit later on, you have to also have that HST number and you have to show that on your receipt. If you're dealing with any sort of motor vehicle expenses, so if you have a car or truck that you use for both farm purposes, as well as personal purposes, like going for medical appointments or whatnot, you should be using a vehicle travel log to outline, what trips you are using that vehicle for business, for your farm, and what trips you are using for personal. So a couple of examples that you should be noting in those vehicle travel logs: when you made that, when did you drive, when did you travel, what was the destination, what was the purpose of that trip, was there any sort of business kilometers or was there any personal kilometers? So did you go to town to meet with the lawyer for your farm and then go and do grocery shopping? You should be recording what was used for personal and what was used for business. And then if you have any travel receipts, so i.e. fuel or food receipts, so did you go look at a piece of equipment and you have to stop and get a coffee? By having that all recorded, that eliminates any sort of, or greatly reduces any sort of issues that you may have when you, if you ever get audited by the Canada Revenue Agency. God forbid that ever happens. In terms of non-financial records that you keep for just your general farm, in case of emergency records, so quite literally, as what the name says, if something goes wrong, if there's a fire, somebody gets hurt, if there's a spill, either a chemical, a fertilizer, or manure, depending on what type you're using on your farm, you should have in your farm, somewhere around your farm or in a couple of different spots on your farm, a way to a list of all the important numbers. So, your 911, fire department, if you, well, most people just have to call 911, but ultimately, if you have any visitors on your farm and something happens, by having these records in place, like what's the 911 number, fire number to your property, or what happens if there's which building's on fire or whoever got injured, where are they located on the farm. By having something like a sketch, in multiple places, then people have that option so that when they're calling 911, they can be as detailed as possible so that the first responders can get there and get to the right spot in a timely fashion. Also too, taking a step back for other non-financial records, there's the list can be quite lengthy, but just as a very, very brief, very similar, a quick sample of some other records that you should be having kept in a safe place will include like wills, power of attorney. So if something happens, who's ultimately going to make decisions for the farm, for yourself, the different bank accounts that are associated with your farm, passwords. Again, I stress this, I make this point as clear as possible that you should be keeping this stuff in a very safe and secure location, but ultimately you should have a list of all your different passwords, and this list should get updated on a regular basis so that if something happens that your second in command or other employees can still access certain information that is being generated by your farm or by your equipment, as well as an emergency contact list. All that should be done on a very regular basis, updated, make sure it's correct, and posted depending on the situation. Very quickly, when it comes to record keeping, should you be focusing on electronic or physical pen and paper type records? The answer is it really depends on your skill level, your comfort level. If you're good with using technology, then albeit go for it, go with electronic. But if you would rather stick with pen and paper, if that what makes you feel comfortable and that you will keep records that way, then use pen and paper. So just keep that in mind that you don't necessarily always have to go electronic. You can always go paper version depending on your situation. And if you are paying for any sort of record keeping services, a couple of quick things to keep in mind. Where is your data being stored? Who has access to my data? How do you upload it? Do you require any specific technology? And I think that's a good time to take a quick break, if that's okay with you, Lori. I would say just a couple of minutes, just stretch your legs, use the washroom, get a drink, because I know we still have lots to go through and with very little time. So if we can keep it as short as possible, that'd be great.
Sounds good, Eric. So it's about 10 after 8, so we'll be back in 3 minutes. How's that?
Sounds good. Sounds good.
If anyone's still sitting at their desk and not going for a break, we can chat too. You know, how are you finding this? Keeping up, hopefully.
I do know that's a lot being thrown at people, and I do apologize, but as you say,
No worries, Eric. Yeah, there's a lot of
hard.
stuff. So it's you're not quite halfway at the moment?
Be close, be close.
Yeah.
So we'll try and keep a good pace. So
Well, we might be a little over after 9. I think that's probably okay with most people. And like we say, it's recorded. So if someone has to leave right at 9, they can catch the last 10 minutes or whatever on the recording. So it will all work. I have a bunch of snowmobilers going past our house. I guess they're trying to get the last dregs of winter, maybe.
I'm surprised. I thought you wouldn't have that much snow up there.
No, we still do, amazingly.
We have snow on the north side of the road, but nothing on the south side.
Oh, really?
The balmy south.
Hey, Eric, it's Sandeep. I just had a quick question while you're sipping water here.
Yep.
Is there like a sample financial statement we can see from a farm? I'm just trying to figure out like what the cash outflows are, you know, or cash inflows are. I think cash outflows is something we can calculate, but like what do the typical cash inflows look like?
Well, I will say this, Sandeep, that it will vary quite like it. Each farm is going to be very different, just because of what type of farm and whatnot. I will see for the end of the presentation if I can find something very quick, and I'll try and post it on, and then we can talk more about it if that works for you. But that's a good point.
Hey, we ready to rock and roll again, Eric?
Let's rock and roll. So thank you for coming back. Hopefully we haven't scared you completely from this. So we'll jump back into our favorite topic, taxation, because ultimately we all have to pay tax one way or another. So when it comes to taxation, whoa. There we go. So you need to, because you're going to be a farm business owner, you're going to have to deal with taxation, or at least the taxation requirements that you have to deal with. So we're just going to do a very quick overview of the different taxation rules. So your income tax as well as HST. I can't stress enough, talk to an accountant or an income tax preparer, ideally, because there are certain rules that are different for agriculture, for farmers compared to general business. If you can find an income tax preparer or an accountant that focuses on or has that knowledge of agriculture taxation, that would be wise, just because of the fact that there's just so many different rules that you have to follow, / you have different tax treatments that you can take advantage of compared to other businesses. So just keep that in mind. So first off, we're going to start off with HST. So most people will know of HST is that 13% that gets charged on practically everything that you buy for personal purposes. As farmers, depending on if you meet the threshold of selling more than $30,000 worth of HST eligible goods, you're required to have an HST number. You can voluntarily go and get an HST number, but there are requirements where you have to file an annual HST return depending on your situation. It could be annual, it could be quarterly, it could be semi-annual, could be monthly. But in most cases, if you're a new farmer and you have decided to register for HST, you'll most likely have to complete your HST return on an annual basis. So the joys of having an HST number is that on the goods that you purchase, so in terms of any repairs that you get from an equipment dealership, or any sort of custom work being done on your property, on your farm, there's usually HST being charged on that, and you can ultimately get that money back by filing an HST return. On the flip side of it, if you are registered for HST, there are some circumstances where you'll have to remit HST back. So if you do any custom work yourself, so I'm saying when I refer to custom work, I'm talking about when you or an operator does planting or harvesting for other farmers, or if other farmers are doing that work for you. That's what I refer to as custom work. And either way, if you are providing that service, you have to charge HST to the farmer or to the landowner, and then ultimately you have to remit that HST portion back to CRA, Canada Revenue Agency. Most cases when it comes to crops, like when you're selling crops, you don't have to deal with HST. You do not have to charge HST. That's an HST exempt good. But some of the other ones, like as I mentioned, custom work, or if you do any sort of trucking, or if you have any sort of off the farm jobs, like if you do any sort of repairs, you have to charge HST and then ultimately remit it. Moving on to the income tax. So ultimately, when you start a farm, you will have to, and you continue farming, you will have to file a business income tax schedule, even if you're a sole proprietor. When it comes to your income tax return, there's different schedules that you'll have to fill out. So as a sole proprietor or partnership, when it comes to a farm, you have to fill out a 1163 or a 2042 schedule, depending on if you're involved with AgriStability or AgriInvest. We'll talk about those two programs a little bit later on. If you're a corporate farm, you have to file an AGR schedule. And again, with these types of schedules, you're outlining your income, your expenses, any sort of equipment and machinery that you have purchased or disposed of or sold of throughout the year, and then any sort of farm inventory that you have on hand at the end of the year. So most cases, I would expect that if you're just starting out, you should be working with an accountant, and they'll walk you through the process in terms of how to get that information all broken down so that they can be as efficient in filing your income tax schedules for your farm business as efficiently as possible. So, obtaining land. So when I was doing this presentation, I first put down purchasing land. And I thought, well, in some cases you may not be able to outright purchase. So I just decided to talk about obtaining land. So we'll talk a little bit about purchasing, but then we'll also talk about other options like renting. And I believe somebody is also renting land at the moment. So so it is possible to start a farm business without necessarily buying or having own any sort of farmland. So obtaining land, as you know, is very important for any sort of new farmer, because ultimately that is your key item that is going to grow crops. Unless you're into greenhouses and into vertical in like downtown Toronto or Hamilton, where they have those indoor greenhouses that they've kind of taken a old building and retrofitted it for, internal greenhouses. That's a different story. But ultimately, most cases, you have to have land so that you can put the seed in the ground and then watch things grow and ultimately harvest. If you haven't already noticed, land prices have gone through the roof in some cases, in some areas. Just in the 2022, I guess it'll be 2021, I should say, Farm Credit Canada, they do an annual land value report. And in Ontario, the average increase in land prices was 19.4%, so quite significant. One thing I will say is that that's a pretty big number. And in some cases, there are some areas, even within counties, even within Ontario, that will have a much higher cost in buying land compared to other areas. So just very briefly, in southwestern Ontario, if you're looking at farmland down in London, you're looking at probably $25,000 an acre, almost 30, maybe $32,000 an acre, depending on the situation. Whereas if you go to, let's say, Renfrew County, out by Ottawa, you might be looking at maybe $10,000 an acre. So keep that in mind when you're looking at, if you're looking at buying farmland. There is, in some cases, cheaper land to take advantage of, but in some cases, that cheaper land might also require you to have more work to be done. So, like, the land might need to be tiled, the land might have to get cleared. So just keep that in mind, that there might be land that is cheaper, but it might require more work on your part to get to be able to grow crops on that land. In terms of purchasing land, small quantities. So in some cases, it might make more sense for you to buy maybe 10, 15, 20 acre lots of land, depending on your scenario, depending on your financial situation. You might pay a higher dollar per acre, but it might be overall, might be cheaper for you to, might be more easier for you to cash flow. By buying smaller farmland or smaller quantities of farmland, that allows you different options to maybe focus on more high income type crops. So, or, dealing with a lot more, like I say, focusing on the fruit and vegetable side of the crop world, and maybe not looking at the corn, soybean, wheat, broad acre world of farming. So that's something to keep in mind, that you don't necessarily always have to buy a 100-acre farm. 25 acres might be suitable for your niche. So just keep that in mind. And finally, leasing or renting farmland or buildings. Like as I say, most people would like to buy farmland. I know I would especially. It'd be nice to buy farmland, but sometimes it's just not affordable or not within your financial situation. So doing any sort of leasing or renting of land or buildings or barns might be something for you to look at. Couple of things to keep in mind. Again, you're not shelling out, 10, 15, 20, $30,000 an acre when you're renting land. Usually it's depending on the situation. It might be between $50 and $300 an acre, depending on where you are. It might be a tad bit more, but it depends on where you are looking at renting this land. On most cases, when it comes to renting land, it's on a year-to-year basis. But in some cases, you might be able to spread that into a multi-year agreement, especially if you're looking at crops that take more than a year to actually become profitable or to get established. One final thing I will say is that having written lease and rental agreements is very imperative to prevent any sort of disagreements or issues where the landlord might tell the tenant to vacate the property or prevent any sort of issues. So just keep in mind that if you're looking at renting land, you should always talk to them about having a written agreement in place. So moving on to using your advisors. So as mentioned earlier, farming starting a farm can be very daunting. But there are people out there that can help you. So I just use the term advisors. So I'm referring to your accountants, your lawyers, lenders. There's actual coaches or mentors out there that will help you, walk you through certain processes. Your agronomists, if you're dealing with like your elevators, ultimately there are people out there that want to see you succeed and will provide some useful information. So the whole idea of having advisors, they are there to provide you independent information and advice for you. But ultimately, at the end of the day, it is your farm business. It's your business. You have to make the decision. You have to take that information, sift it through, and say, yes, we're going to do X, or no, we're going to do Y instead. And here's the reasons why. In some cases, it is normal to have multiple advisors involved in a conversation. So as you say, for buying farmland, you might have an accountant involved, a lawyer involved, a real estate agent involved, a lender involved, a coach or a mentor involved. Like, here, I don't want to call it a simple transaction of buying farmland, but you have so many different areas that you need to get that key independent information and advice to make sure that, yes, it does make sense to buy that parcel of land, or no, actually it makes more sense to buy another parcel or rent another parcel down the road. So just keep that in mind. And you also have to remember too that you have to make sure when you're working with advisors that you understand what their expertise is. So an example is that you do not want an accountant to be providing advice on dealing with a certain pest or disease or weed. That's where an agronomist comes into place. And vice versa, you don't necessarily want an agronomist to provide you tax advice, because again, they focus on what a crop needs, not what the income tax and what the Canada Revenue Agency requires you to do. So just keep that in mind. So I guess the next thing when it comes to advisors, if you don't have an advisor, where can you find an advisor, or who do you talk to? So if you feel comfortable with it, ask your friends, ask your neighbors, lenders, other farmers for any suggestions. Word of mouth is pretty big when it comes to working in the agriculture world. Also too, there is professional organizations for most advisors. that you can follow. You can see on the list the different member directories that you can utilize for your accountants, your lawyers. If you're looking at buying farmland, real estate agents, certified crop advisor, or agronomist, you have all these options available if you want to, go on to these different associations and then do your search yourself. Or as I said, you talk to some neighbors, talk to some farmers, and I'm quite sure most of them will say, oh, well, I work with this person, I really like him, or I've worked with this person, I didn't like him because of X, Y, and Z. So keep that in mind. So we're making pretty good time. We've gone through the general aspects when it comes to farm, for starting a farm business, for running a farm business. I know that was a very high level that we went through. Now we're going to focus more on your crop farming side of things. So again, we're going to focus on, your different record keepings and the business side of things. And as I mentioned earlier, if you do have any specific questions when it comes to, specific crops or diseases or pests or whatnot, as you say, reach out to an agronomist because again, that's their role. They will walk you through and they will be able to provide that information for how to deal with that situation. So just keep that in mind. So we'll move into crop financing. So congratulations, you bought a farm, you've rented land, and you got some equipment on hand, and you're now trying to figure out, how do I pay for putting the seed in the ground? One comment I will make, this one person made a very interesting comment to me, and it was, when it comes to farmers, he believed, was the only profession where they would put thousands of dollars into the ground through seed and fertilizer and chemical and tillage and time, blood, sweat, and tears, and then walk away for 3 or 4 or 5 or 6 months and then expect to get all that money back out when they go to harvest it. Is the idea that farmers can be very optimistic. And so, but ultimately at the end of the day, you have to be able to have funds, cash flow to ultimately get the seed into the ground and ultimately back out and sold either through, as you say, an elevator or through selling crops through direct farm, like directly to the consumers. So when it comes to the different options to finance your business, so we'll talk about a few general options for your day-to-day activities. So if you haven't heard of these terms, you might have heard of lines of credit, term loans, and leases. So we'll quickly go through those, and then we'll go into a few more specific programs that are available, like the advanced payment program and tile drainage program, but we'll get to that in a very short period of time. So first thing, when it comes to lines of credit, so it's a financing product that allows you to withdraw money and to pay it off depending on your situation, depending on your cash flow. So what usually happens is that when you're dealing with the lender, they will grant you, or they will authorize that you have access to a line of credit of 10,000, 20,000, 30, whatever amount it is. And then it's your responsibility to stay within that. So there might be some months where you decide that you need excess money because you have to pay for repairs or pay for seed, and you might have to go into your line of credit. And as long as you are within your maximum amount that you can withdraw, you're good. And then when that crop comes off, or when you get money coming in from other sources, then you can pay that down. And there's no additional fines or penalties compared to other financing options when you're dealing with that. So that's the joys of lines of credit. It's to help you deal with short-term cash flow shortages. Like, as I said, like when buying seed or crop inputs. one thing I will say is that whether or not you use that line of credit, if it has been granted to you, the lender will usually charge a monthly fee to even though you may not have utilized that line of credit, the lender might still charge you a $10, $15, $25 fee depending on the situation. So keep that in mind. And as I mentioned, the idea of the line of credit is to deal with short-term cash flow shortages, or as you say, that ultimately you should be able to pay that line of credit off within 12 months. That's the whole idea of it. May not happen depending on the situation, but again, it's more meant for, you know, to buy inventory or to deal with crops that you know that are going to come harvested and ultimately get paid within 12, 13 months. Term loans, next on the list, they focus on a more of a 5 to 10 year fixed program. So term loan, that's more so when you're buying equipment. So tractors, cultivators, combines, any sort of harvesting equipment. Again, that idea is that, you know what you have a specific asset tied to that term loan, and that you will be paying that off over a certain number of years. So in this case, 5 to 10 years. So again, you can see term loans that are variable interest rates, fixed interest rates, really depends on what your needs are. And that's a conversation that you'll have with the lender or with the equipment salesperson that you're dealing with. And when it comes to payments, there's usually a fixed schedule that you have to abide by. So by March 1st or by the 1st of every month, you have to make this payment, or 1st of every 3 months. That's all outlined when you agree to this to these term loans. So usually when it comes to any sort of fees, of course there's interest, but additional fees, there's usually a one-time fee at the beginning of the loan to register the loan. But beyond that, once you are in years 2, 3, 4, 5, whatever year it is, there's no additional fees. But again, that can change depending on the situation of that term loan. And again, the idea of these term loans is to purchase equipment or establishing, I have here like vines, but just like trees, like if you're dealing with apples or pears or any sort of crops that take more than a year to get established, that's where a term loan would be beneficial. Next on the list are leases. So they are similar to term loans, but when it comes to leases, you as the farmer do not necessarily own that piece of equipment. The leasing company ultimately does. So when it comes to the lifespan, so like a term loan, as I mentioned earlier, you usually see that 5, 10 years, where with a lease, it's more so like 3 to 7 years, depending on the situation. One thing about leases, most leasing companies will not necessarily take on a piece of equipment if it's more than 20 years of age. So just keep that in mind. If you're working with a leasing company for buying any sort of equipment or leasing any sort of equipment, that could be a sticking point. So just keep that in mind. Interest rate is usually fixed when it comes to a lease, but is more expensive compared to a term loan in some cases. So the life of a lease is very different compared to a life of a term loan, because as you say, when it comes to a term loan, ultimately you go, you work with a financing company or working with an equipment dealership, and they will say, okay, you're going to buy this piece of equipment for X price, and we're going to charge you 3, 4, 5, 6, 7% interest, and you have until, every month you have to make a certain payment, and at the end of the financing agreement or at the end of the loan, you own the piece of equipment, and that's the end of it. But with a lease, it's a little bit more slightly different. So when it comes to the start of a lease, usually you have to pay a down payment. you may have that option. You may have to pay a down payment for an equipment loan as well, like a term loan, but it's not as usual as with a lease. Usually with a lease, you have to at least make 1 month's worth of payments as a down payment, and then additional security deposit may also be charged. When it comes to the life of the lease throughout the year or throughout the years, again, similar to a loan, that will be all determined at the beginning of the lease. So it could be bi-weekly, monthly, quarterly, semi-annually. You'll have to make payments. Very rarely do leases happen on an annual basis, but it may. One thing that is slightly different from a lease versus a term loan, when it comes to a term loan, usually you're paying a principal portion and an interest portion on a term loan, and the interest that you are being charged is tax deductible, but not the principal payment. Where with the life of a lease, when you're dealing with leases, the actual payment can be tax deductible. And because ultimately you do not necessarily own that piece of equipment, you're more so renting that piece of equipment. Also, too, something to keep in mind on when it comes to leases, I haven't written it down here. Lease payments are usually subjected to HST, where with a term loan, there's no HST. So just keep that in mind. When it comes to the end of the lease, so you're in the final month or a couple of months of your lease, you'll usually get a piece of paper from the leasing company, and they will say, congratulations, we're at the end of the lease agreement. Now you have a couple of options. And usually, depending on the situation, when it comes to a lease, there's a buyout option, which can be as low as $1. It could be as high as, maybe 10% of the value or 15% of the value or 20. It all really depends on the piece of equipment that you're looking at buying. So at the end of the lease, you have to determine, do you want to buy that piece of equipment and make that payment? And then ultimately, you're done with the lease, or you can return the lease. So you could say to the leasing company, thanks, I like the piece of equipment, but I don't want to buy it out anymore. It's in good shape. You can take it back, and they will take it back, and the leasing company then has the responsibility to do whatever it wants with it. It can sell it. It can do whatever, right? And then also too, third option is you can continue on using the lease payment schedule or payment scheme that you have been doing for the last number of years, but it may not affect, it may not lower the balance. It might be just like, as you say, if you're just renting that piece of equipment. So those are your three options at the end of the lease, and that's kind of a short version of the life cycle of the lease. So now we're going to switch over into some of the different programs that you might run into when it comes to financing certain aspects of your farm business. So, more specifically like with your farmland. So the first one we're going to talk to you about is the tile drainage loan program. So if you have to complete any tiling of property, or if you have a wet spot on your farm and you need to drain it, you can get some financing through your municipal government, your municipality. So the terms of the loan are a 10-year term. Payments are usually made on an annual basis. The competitive interest rates are set by OMAFRA, and ultimately OMAFRA, when it comes to this type of a program, OMAFRA is providing assurance to the municipalities that if something goes wrong, that it's will get funded. 75% of the eligible costs can be financed, and loan applications for this program can be obtained at your local municipal office or at the municipal office where the farm property is. So if you are in a situation where you are living in one municipality but the farm is in another municipality, you have to go to the municipality where that farmland is in. One thing I will mention too here when it comes to eligible costs, so you can only you can participate in this program if you use a licensed tile drainage operator. So there is a list on OMAFRA's website. If you go to ontario.ca and list out and type out licensed tile drainage operators, it'll take you to that fact sheet, and then you can figure out who you can talk to about tiling your property, and then ultimately go to your municipality. So next on the list, so now we're going to move more into financing crops. So next on the list is the Advanced Payment Program. So this is a program that's administered through the Agriculture Credit Corporation, or ACC. So the idea of this program is to finance or to provide funding for farmers to buy crop inputs and to be able to have enough money on hand to survive until crops are harvested and crops are sold. So maximum loan amount is $1 million, which might be something you may not have to worry about if you're just starting out. The first $100,000 is interest-free. The remaining amount is at prime interest rate. Now, one thing I will mention is that last year and this year, if you participate in the advanced payments program, the interest-free portion has been increased to $250,000. So that's good for us as farmers. Now, for 2024 and beyond, we're not 100% sure what's going to happen. So, you know, for this year, you can utilize $250,000, but for going forward, may be reverted back to 100,000, or they may choose a different number, but that hasn't been determined as of yet. That's all done through the federal government. So the financing rates or the loan rates that are established by ACC. So when it comes to, you know, to determining what amount they can finance for your operation, they use a couple of factors. So they'll use your production, so what your average farm yield is. They will also use your guaranteed production. So when I refer to guaranteed production, I'm referring to the production insurance program. And we will talk about production insurance at the end of the presentation, so bear with me for it. And then they have a rate for how much value or how much they're willing to finance for that crop. And ultimately, the idea is that they're going to finance about 50% of the market value of that crop. That's the short Coles Notes version on that. Repayment deadline to ultimately you have to make pay the loan back. It's either when the crop has been sold or by a specific deadline, depending on whether or not your crop is storable or not storable. And when I refer to that, so pretty simple example would be, as I said, corn, soybeans, wheat. That's a crop that you can store for as long as possible with no real specific issues. But when you're dealing with like grapes or apples, your fruits and vegetables, they're not as storable. So they have a different deadline compared to, you know, your corn, soybean, wheat crops. So when it comes to applying, you just call that number 1-888-278-8807, and they will walk you through the process, and then they'll ultimately, you know, tell you what the next steps are, and then you'll have financing. Everything's all good. Next option is the commodity loan program. It is also administered through ACC, but it's guaranteed by Ministry of Agriculture, Food and Rural Affairs. Interest rate, there's no interest-free portion with the commodity loan program. Interest rate is at prime. Again, loan rates are predetermined by ACC, or the financing rates are determined by ACC. You can only I know, you can finance up to $750,000 compared to the advanced payment programs. That's $1 million. You have up to 22 months to repay the loan. Deadline to repay the loan is September 30th. And this program is only available for crops, not for livestock. And I know this is not the livestock sector session for tonight, but just want to point that out. And again, to apply, just call that number on your screen and they'll be able to help you.